Good afternoon, good morning, good evening, Bala. We're back, and I'm so sorry for the technical difficulty. We were here for a while. We're just going to wait for a few minutes until people start logging in, and I'm just going to wait. Okay, great sunny days. Good, Miss Katrina, I'm so glad you're online. I was really looking for you. Excited to see you. So I'm just going to get started here, and if you just kind of wait for a few more members to get online. I'm Tanya Munford Pitts, and I am with Expat Tax Solutions, LLC. We are now, thankfully a global company. Thanks to you all out there. We are a tax consulting, tax preparation, business consulting, and accounting office and firm. We've been in business now for 13 years, going on 14 years as a matter of fact. So yay! We have been serving clients originally in the Macon, Georgia area. That's where we're based out of. And also we have had an office located in Kuwait for about 3 years. We just kind of ended that agreement recently and pretty much operating solely online with clients all over the world. So we're excited. We're excited to talk expat taxes with you. We're excited about giving you as much information as you need to help you make a decision as to how to handle your taxes for this coming year. We have 3 people in our office. Myself, I'm the owner. And we have 2 other awesome ladies in the office, and quite a few of you may have even worked with them in the past. Miss Alpha Racine Lundy, she's also a tax preparer and the office manager. And then Miss Janelle Barlow, she is the client support manager. So she kind of directs the traffic in our office and makes sure that we stay on our P's and Q's and make sure everything gets out on time. So today, basically what we're going to discuss is expat taxes. Of course, whether you're living abroad or if you're living in the U.S., we already know that we always have a responsibility to file our taxes. Okay, so the IRS doesn't care if you are in the U.S. and they don't care if you're in another country. So as a result, we have to file our taxes. Please don't be disillusioned, I will say, or please don't be caught off guard with thinking that just because you are in another country and you're working for a foreign employer that you're not required to file your taxes. There's always a requirement, and the requirement is always based on the amount of your income. And in this situation, anytime your income is over $13,000 in U.S. Currency, and that's from earned income, then you have a requirement to file those taxes. We have a question, and I'm going to try to go through as many of the questions as we can, and I'm looking at 2 screens. One was, please explain the 30-day rule when you finish the introduction. Sorry. So the question is, the 30-day rule is, and it's not necessarily a 30-day rule. The requirement is that you have to be, there's 2 different ways that you can file your return and qualify for the foreign income exclusion, which is really a great tax benefit. And the tax benefit for the foreign income exclusion requires that under the physical presence test, you have to be in country physically for at least 330 days within any 12-month period. So your 12-month period can span from January 1st through December 31st. Your 12-month period can span across 2 different tax years or calendar years. So it could be from June 1st, 2016 through June 30th, May 31st, 2017. And that will be considered a 12-month period. So those 330 days don't have to be consecutive. They can be sporadic. You can take a week here, a week there. You can take them all together. But you have to be in that country, physically located, for 330 days out of that year. Or you have to be located outside of the United States is really the way it's best interpreted. Outside of the United States for a full 330 days out of any 12-month period. The next question was, what kind of proof of my foreign income does the IRS expect me to provide? And you know, this is a great question as well. It's kind of tricky. And I say it's kind of tricky because often some companies, if it's not a U.S. employer that is deducting taxes, then we have to find a way to, of course, prove our income. My suggestion to my clients is, and always has been, any type of bank deposit. Why? Because it's traceable. So if the company doesn't provide you with a salary statement at the end of the year, or you don't have a contract, which most often you go overseas, you do have a contract. So you have the option of using those. Whatever's best going to uphold your income, okay? To me, bank deposits work best, but if the company is paying you cash, then you have to use a contract of some sort to prove that. The other question, going back to the 2 types of tests, the physical presence test and the bona fide residence test. And I'm sorry, this is my first time, so work with me. But the other test is physical presence, and the bona fide residency is the other test. Under the bona fide residency, and I'm going to kind of elaborate on this one a little bit more because the IRS has been a lot more particular about clients claiming or taxpayers claiming the bona fide residency test here of late. 2 or 3 years ago, you know, I would say if you knew you were going to be located in another country for over 2 years, we can try to go for the bona fide residency test, but lately we've had some audits come up and they're pretty strict on it. So the bona fide residency test states this. It says you have to be located in the country. This has to be your tax home for a full calendar year from January 1st through December 31st. You don't have to be physically located in that country, but you definitely have to make that your tax home. The other part of the test is once you're there a full calendar year, or that's your tax home for a full calendar year, then you also have to say that you have the intention of making this your tax home. And it's kind of hard to prove if you're on a 2-year contract, you know that at the end of your 2-year contract that you're going to leave, then it's hard to prove to the IRS that your intention is for this particular country to be your tax home. And that's the basis and premise that they go by as well. The third criteria, it's very, very subjective. And we've been kind of fighting a lot of claims on this one as well. They want to know if you are entrenched in the community that you're working in, or the country that you're working in. So, and it's very, very hard to prove to them that you're entrenched in this community. And I don't care how much documentation you provide, they have their subjective guidelines to which they're following. So we've had clients that have submitted, They've submitted their driver's licenses. They've submitted the fact that they don't own a home in the United States. They've submitted, their wives are living over there with them in that country, and they're still giving them a hard time or a difficult time with proving that they're a bona fide resident. So to go back to those two tests, the physical presence test and the bona fide residence test, the best option is always the bona fide residence test, because you don't have to prove, or you're not restricted to the 330-day rule. So quite honestly, it is the best option, but it's the most difficult to prove. So, and this is really important for me to educators, because I know you operate off of a certain school schedule. You have quite a bit of time off, and we've all been, using time to go home to the U.S. My suggestion is, if you select or elect the bona fide residence option, my suggestion is that you don't spend as much time in the United States on your time off. This prevents you from having to prove and provide the substantial documentation and possibly having it subsequently rejected. This prevents you from having that issue or falling into that particular scenario. So those are your two options for claiming the foreign income exclusion, which is basically the benefit of being an expatriate and working in another country. You're able to forego so much of your income. How much of your income? This year, the foreign income exclusion says anything under $100,800 is excluded as income for tax purposes. So, of course, going overseas, that is the benefit. So we don't want to miss out on those opportunities. Okay? Another question is, what happens if I don't file? Well, what happens if I don't file? In the past, people have been able to get away with not filing for years, and especially if you're working for a foreign employer. Why? Because that foreign employer is not posting any of this income to your Social Security account. So therefore, they have no record of your filing. So that's there's a good and a bad to this. You don't have the income showing. They don't see a requirement for you to file. However, on the other side of it is, you don't have any income showing up on your Social Security record. So in essence, when the time comes for you to file for Social Security, you don't have that information recorded. They don't see you as earning any income. So for me and our office and the clients that we talk to, we always suggest file the tax return, even if you don't owe anything, even if you don't have to pay any taxes. File the return, because it protects you and it protects your income and it protects your earnings statement on the Social Security side. The other problem is, if you don't file, if you do earn income over the threshold of the foreign income exclusion, then you'll have penalties and interest that you could possibly be taxed or penalized for once you do file your return. So it's very important that you file every year, no matter what. And I will never suggest that you don't file, but if you choose not to because you don't owe, or you feel that you don't owe, then that will be something that you would have to eventually deal with, later on down the road. There's also opportunities where you're coming from the U.S. and you're working half of the year in the U.S. and you're working half of the year in the other country. Well, there is taxable income there. So because you're in the United States, all of the income you earned in the U.S. prior to going overseas becomes taxable income. As a result, then it's possible that you will have a tax liability for that particular year. And it's possible that you will receive a refund. And if after 3 years you haven't filed the return, then you cannot claim that refund on that income that you earned in the U.S. or any taxes that you had withheld. And so that could cause problems for you. Or it wouldn't be a problem. It would just be a missed opportunity to receive the refund of the withholdings that you had come out of your wages over time. Okay. Another question, I moved abroad in July 2016, so I don't qualify for physical presence for the 2016 tax year. Would I have to pay U.S. taxes on the foreign income? Now again, it doesn't say you don't qualify for the physical presence test, because remember, your physical presence can overlap tax years. So you can be physically present in the U.S., and I'm not sure of the date. Well, you said July, sorry. So from July 1st, we'll just use that as an example, to June 30th would be your 12-month period, okay? So long as from July 1st through June 30th, you haven't expended more than 330 days out of that country or out of the U.S., then you're okay. You shouldn't have any problems. As long as you haven't visited the U.S. for more than 35 days, then you are okay. And the only issue, the only caveat to it is that you would have you wouldn't receive the full foreign income exclusion. It would be a proportionate amount based on the amount of time that you actually spent in that foreign country. Okay? So if you need some assistance with that, we'll be glad to help you, but you still have a requirement to file. And it's possible that you would receive, a proportionate or discounted amount of the foreign income exclusion. Maybe not the full amount, definitely not the full amount, but a partial amount. Have you heard of the U.S. government not renewing passports because of not filing? I haven't heard of them not renewing because of not filing, but I have heard of them not renewing because of tax liabilities. And the tax liabilities threshold is $50,000 for any amounts, including penalties and interest. So if you have a tax liability of $50,000, then definitely they will not renew your passport. Now, this doesn't say that if you don't have an installment agreement in place. They just want to make sure you recognize that you are going to pay these taxes, and they need to know by when you'll be finished paying for it. So the installment agreement helps you with, I'm laughing at the next comment, the installment agreement will help you with getting that situation at bay so that you can renew your passport. Okay? Now something to keep in mind, though, for those especially that work for U.S. employers in foreign countries where they do report your earnings to the IRS and to the Social Security base, is that if you don't file the returns after a certain amount of time, then they are going to definitely file those returns for you. Okay? As a result, since you have to file, they'll file the returns for you. Most times the reason they're filing that return is because you owe. They won't file your return if they owe you a refund. You better believe that. And I've seen it too many times. I have many clients that, they hadn't filed the returns. They didn't know they had to file, but they also had withholdings, and they were due a refund. And so here we are 6 years later, they missed out on $2,000-$3,000 in refunds because, one, they didn't think they had to file, and two, they didn't file. So we always encourage you, to just go ahead, take the leap, and go ahead and prepare the return and file it when you're ready to do that. The comment was, I make peanuts and ice water, so even a partial exclusion would work. And I'm not commenting on your income, but a lot of times the partial exclusion does work. And to be honest, is normally in proportion to the amount of time you worked over there, which is in proportion to the amount of your income for a partial year. So most often, so you're thinking if the income exclusion is 100,800, if you were there half a year, if you made under $50,000, that half of that year, then that portion of that income would be excluded. Those are all examples. Don't take my word verbatim because everybody's situation is different. And we never, place everybody in a lump basket, lump them all in a basket and say, okay, everybody's situation is going to be the same. I tell my clients, you can make the exact same amount as your neighbor, same house, same car, same situation, but everyone's outcome is going to be different for a variety of factors. If I use my 335 days over 2 tax years, how do I indicate on my return? It's over 1 tax year. It's over 1 12-month period. So we don't tell people how to prepare their return. Of course, we're going to refer you to us. But definitely it's a 12-month period, which would cross 2 tax years. The guidance can show you how to indicate that on your return, or you can come to us and we'll be glad to help you. If I have income property, I must file every year, right? Correct. Income producing property is income, whether it's a net profit or a net loss. So you're overseas, your income falls under the exclusion amount, and you have this income producing property in the U.S., which is great. I think that's a great investment vehicle. So, but your income producing property for tax purposes is not producing you any income, okay? Because on paper, well, in your wallet is producing income, but on paper is not. And there's a variety of reasons why that would occur. But still, regardless, you're supposed to file the return for that income producing property no matter what. You don't get a break. Okay? Okay, so with your income, the foreign income that you received in the U.S., let's talk about we've talked about the 2 different tests, the bona fide residence and the physical presence test. Okay, now let's talk about the income, because the income is excluded for tax purposes. But I'll go back to the example that I gave before, where you come over half the year and you're working in the U.S. for part of the year, and then you're working for another company. You're working in a foreign country for the other part of the year. So what happens is you have this taxable income from the U.S. and you have this foreign income excluded income from this foreign country. And so what the IRS has done so beautifully, as they do always, which is beautiful for them. That's why I say it's beautiful. But whereas in the U.S. you may have been in a 10, 15, 20% tax bracket. You may even been at a 25% tax bracket, but we're going to go with under 20%. That's where we would like to get our taxable income down to, including deductions and exclusions and adjustments. So now we have this taxable income from the earnings that you had in the U.S. And then we have all of this excluded income from this foreign country, which we're going to say all of your income is excluded. So this taxable income from the U.S. now gets taxed at a higher tax rate. So, and it happens every year. Client brings me the tax documents. They have taxable income from the U.S. and taxable income from the foreign, non-taxable or excluded income from the other country. And when we pull the numbers together, they are not receiving the refunds or the credits that they were receiving before. And so now they're looking at me saying, hey, well, what's going on? I normally receive a refund, and all of this income is excluded, what's going on? So what they do is they tax your taxable income, be it whether it's from all of your income is excluded. This is all U.S. taxable income. They raise that to a 25 to 30% tax bracket. So that $50,000 that you earned in the U.S. that's taxable, instead of being taxed at a 10% tax rate, is now taxed at 25%. So that brings your tax, of course, it raises your tax bracket, raises that taxable income, and therefore your tax is more. And a lot of times you haven't had enough taxes withheld to offset that new tax rate. So keep that in mind. Even if you don't use our office, don't be mad at your tax preparer, because this is just part of the whole process. So also, if your foreign income does exceed the foreign income exclusion, so if the exclusion amount is $100,800 and you're making $150,800, well, that $50,000 is considered taxable income now. So we're going to say $50,000 after dependency exemptions and after your standard or itemized deductions, after your student loan interest, after all of those adjustments we're able to make on page 1 of your 1040. So now this $50,000 is subject to tax. And it's not subject to tax at the same tax rate that it had been in the U.S., which could have been, 15%. Now it's taxed at a 25% minimum tax rate. Okay? So you should be prepared, and 25% of $50,000 is a lot. It's $12,500. And I'm saying a lot for tax purposes because nobody wants to pay taxes. Nobody wants to pay taxes. I don't even want to pay taxes. It's part of the process, but that is what's going on here. So if you make more than the foreign income exclusion, because in a perfect world, we would like to have all of it excluded, but that's not how it works. For that $50,000, you need to make sure that A, you have enough deductions and exemptions and adjustments and family, children, mothers to offset this $50,000 in income, or you need to make sure you put the taxes aside for it, or you may want to start investing in an investment vehicle that will also reduce your taxable income. IRAs, if you're with your company's 401k and they're a foreign employer and they're off, foreign or otherwise, and they offer it, you go ahead and put your money in an investment vehicle, and that'll reduce your taxable income. Okay, let's see. It says I'll go back to a question. And thank you for the kudos. We really appreciate it. Wait, I'm late. If I make less than the amount necessary for income tax, do I need to file? That's a tricky question. If your question is if you make less than $13,000, which is the requirement, then yes, you do not have to file. But if it is, if I make less than the foreign income exclusion amount, say for instance you make more than 13, then yes, you do have to file. So no, you do not have to file if you make less than the required minimum for filing a tax return, period. Or yes, you do have to file if you make under the the foreign income exclusion, but more than the required minimum for filing a tax return. And even if you have investment interest in the amount of about, I think it's $3,200, I'll double check, but if you just have strictly investment income, then you have a requirement to file that tax return just solely on the investment interest as well, investment income. Okay, let's see. We have a couple more questions. It says, I will be taking a sabbatical for the remainder of the 2017 and will have no income. Is your advice to file anyway, just so that the IRS doesn't trip out? Again, it kind of goes back. Okay, you got it. It went back to the other question. What happens if I fail the bona fide residency test or am audited? Great question, because we're working with a couple of clients that have failed the bona fide residency test. In our eyes, they haven't. They qualify. We had all the documentation to substantiate the fact that they are considered a bona fide resident. This has been this client's tax home for 7 years. He and his wife have been living in this foreign country for 7 years. They do not have a tax home in the U.S. They don't have a home in the U.S. And no matter what the documentation is that we've submitted to prove that, they are not going along with it. And there's a couple of other issues that go along with that particular situation. You know, documentation that was submitted by the employer was not, actually wasn't on point to me in order to submit, but this is what they provided. So if you fail the bona fide residency test, my suggestion is that you are able to qualify for the physical presence test. And we always work with the clients to make sure that we get a travel log that's accurate and is based on your passport, because they do request copies of the passport as well. So what we're doing is always suggesting that you qualify for the physical presence test. And even if you get audited and you don't qualify for the physical presence test in full for that year, you could always qualify for a partial year, which means in turn you may have to pay taxes on some of that income. So just make sure that the information that you provide to your preparer is based on the information that's in your passport. They must match. We can't help you fix that, and we don't even try. So if you tell me you were out of the country for only 30 days, that's what I'm going to place on your return. I know, I'm sorry. I got an old face, but that's the truth. You know, we don't try to help clients put information together that's not accurate. It comes back on both of us, and you know, no one wants that kind of problem with the IRS. So if you have to pay a tax, there's always, if you're audited and they rule that you don't qualify, and then the physical presence test fails, then the next step is to qualify for an installment agreement, suck it up and pay the tax, and then we'll do it right the next time. Although I will say we are working pretty hard to contact someone at the Internal Revenue Service that can actually help us resolve this situation, because the guidelines strictly state, these are the criteria. And if every guideline is going to be subjective after that, then no one will ever win. So we are working on that in our office, because the nature of our job is working with expatriates. And so we would like to be successful in assisting our clients with any situations like this that may come up. I work full-time in the country of Qatar and make less than the combined salary and benefits allotment. I do pay real estate taxes for property I own. I do not rent the property out, but wondered if I would be better off tax-wise if I did rent out the property. I don't understand, I don't understand the first part of the first sentence, and make less than the combined salary and benefits allotment. I'm not understanding that part. Real estate taxes, and you're not renting the property out. That would kind of be that would be something that you would want to decide on your own for investment purposes. If you are looking to reduce your taxable income, rental property can sometimes benefit you in that situation, but there are times when you're making more than any of the expenses, so potentially you could pay taxes on it. So that would be something that we would suggest. If you want to sit down and talk about that person to person, we could consult with you on that. Put it on paper, see what it looks like, and then we can discuss it. But that's an individual, personalized situation. I wouldn't want to give you any random, cookie cutter advice because every situation is different. Do days in transit to the U.S. count as days for the physical presence test? They do, but they want to know if you're cutting it close. If you are at 335 days, 330 days, I'm sorry, or 35 days out of the country, and you're cutting it really close, like those 2 days will potentially make 36 days, then yes. Again, an audit we went through, we went from the bona fide residence to the physical presence test, and the calculation that the agent used, they used those days in transit. And again, I think because there's so many people working overseas now, I don't know how many there were, but the percentage has increased, I'm assuming over the years, that the IRS is now, really scrutinizing this physical presence test and bona fide residency test for expatriates. So my suggestion is, again, if you're cutting it close, then, if you leave the U.S. at 12 a.m., then those extra hours will count, when you get on the other end or you get back to the foreign country, or vice versa. If you leave late at night and you're, within a 12-hour time span, then they may take those 12 hours that you arrived and the 12 hours that you left, and they could potentially use that against you. My suggestion, don't cut it close. Give yourself some leeway. Let's see. The other, because I know there are a lot of educators on here, and I always talk about this in all of my seminars with clients, especially educators that are working for foreign employers that are not reporting income to the U.S. and you're not having this on your Social Security statement. My suggestion is, I don't always say everybody should invest in, some type of investment vehicle. Everybody should always pay Social Security taxes. I don't say any of that. I always suggest, though, that you pay attention to that fact that you're not having this income reported on your Social Security statement. So as a result, if you're not filing your taxes, or even if you are, you're having all of this income excluded, the opportunity to invest in an investment vehicle is greater because most of your income is excluded. So pay attention to that. Your quarters aren't being reported, so you have to find a way to offset this time that you're losing from your Social Security earnings statements. I think, any more questions? We can do it, and the next thing, two things actually. You actually have until June 15th, and this year's June 18th again, if I'm not mistaken, because we got a couple of extra days since the 15th falls on June 15th. I'm sorry. June 15th is the filing deadline for anyone located overseas. If you don't think you will be ready to file by then, make sure, be certain that you file for an extension. You can do that through our office. You can do it online. You can do it in any shape, fashion, or form that you want. But do make sure that you file the extension. The other thing is, if you have a foreign bank account, that is really, really big now. Any amount over $10,000 that you have in a foreign bank account on any day in 2016, you're required to file that FBAR, or foreign bank account. You're supposed to fall under the auspices of the Foreign Bank Account Reporting Act, which is the FBAR. So, and that is any one day. If you had $10,000 in that account on June 3rd, and that's the only time you had it, you're supposed to report that income on the FBAR. This year, they're allowing you to extend to October 15th. so that you can file your F-bar if you're not ready. But you have to file for an extension for that as well. And that will be separate from your extension for your tax returns. Okay? And I think we're going to wrap up here in about 1 minute. I'll wait for a couple of more questions. We have been really busy trying to get through this tax season, and ours is extended since we're working with Expatriates. We really enjoy it. We are on Facebook under Expat Tax Solutions / Advanced Tax Solutions. We are on LinkedIn under Expat Tax Solutions. You can find us there, or Tanya Munford Pitts. Again, we have been in business for 13 years, but I've been preparing taxes for well over 20 years. I'm an enrolled agent. If you have any questions or concerns, we can always take some time to get a power of attorney from you. We can resolve tax matters for you no matter where you are. If you need to file taxes for multiple years, we've done that. We'll do that. We can pull tax transcripts for you if you don't want to go through the process yourself. We can also contact the IRS on your behalf if you're having any situations with some outstanding tax matters. We're pretty much doing it all. We also do provide accounting services, bookkeeping, business consulting. If you need assistance with establishing LLCs or any business setups, we're able to assist you with that as well. We would love to wait until tax season is over, but we know that sometimes things come up and everybody needs things whenever they need it. So we're available. If you have any questions, you can reach out to us. We have an email address, Expat Tax Solutions, or taxes@expattaxsolutions.com. And you can also find us on our website at expattaxsolutions.com. I hope we've answered all of your questions. Hopefully I'll get a chance to speak with Ms. Katrina again. I will, and maybe we can do another forum just before the June 15th deadline. Hit us up on our inboxes and emails, and you can always give us a call as well. And we're also on WhatsApp. So just reach out anytime. We'll be glad to help you. Thank you so much, and I've enjoyed it, and I hope I've answered all of your questions. Have a great evening, afternoon, or morning. Bye-bye.